Hey, good morning. Let's get started. How is everybody? Okay. All right, just a couple of days away from spring break, so try your best to stir up your energy if you can this morning. We started off Chapter 8 on Monday. It's on receivables. So receivables on Monday, we talked about estimations on allowance methods, which breaks down to percent of sales and also aging methods. Okay, so this is just a brief summary of what we just covered on Monday. So let's just go over it again, and then we'll talk about another method called direct write-off. So the first entry here, everything starts off from making sales to customers on account. Right, so the first two entries here, we have two customers. We made sales on account, provided services on account. This is the first on-account entry. And then later on, every single month, if the company gives out monthly statement, or if they give out quarterly statements, and we will usually estimate the part of allowances that belongs to uncollectibles based on prior year's experiences. So the second entry here, based on the $15,000 credit sales in this period of time, companies based on prior experience assume 2% of these are deemed as uncollectibles. So we measure up an uncollectible account expense, recognize this as the cost of doing business, and then we credit allowances for uncollectibles. So this is the second entry using percent of sales method. Now most of the cash sales on account, later on, the normal process is collecting it by cash. So the third entry is the majority of the entries. We're just making sales on accounts and have cash collections by debiting cash, crediting accounts receivables. Okay, so the middle part here is most of the entries that happen within the period of time, cash collections. And then at the end, let's say after a few weeks or a couple of months, different companies have different measures to different period of times to determine which other accounts are considered uncollectibles. But once they determine these two customers, their accounts receivables are not collectible, later on they will write off this entry by using up the pool of allowances and then crediting accounts receivables. So this middle entry here, we write off this entry using up the pool that we estimated, assign these to the customer's accounts receivables account, and basically take it off from the statements. So this is not saying that these customers no longer owe us the money. They still do, but we don't want to overestimate accounts receivables because if these, after several attempts, we're just not collecting the money on time. We would write it off and turn these into attorneys or other debt collection companies. So the middle part here is writing off the entries, using up the pool, assigning it to accounts receivables. Now this last entry at year end, remember we also talked about another method called aging methods. So we look at all the entire set of accounts receivables, group them by their age. So we have a month-old accounts receivables, 2 months old, 3 months and up. So based on the age of accounts, we also measure up at year end the target balance of allowances, then compare it with what we have in our account. And the difference is this part, you can think of this as adjusting entry for allowances. So at year end, we make another entry based on aging methods. Debit and collectibles, also credit allowances. So the entries here are using aging and percent of sales, shares the same account, and the purpose is also the same. We want to measure up front the uncollectibles based on prior year's experiences. Lastly, we talked about an entry called recovery entries. So if previously we've written off some of the accounts, and later on customers came to us, pay us back the money, we have to reverse earlier written off entry. So these two entries here, this one basically is flipping the write-off entry we made earlier. And then the second entry is just a regular cash collection entry. Okay, so this is a summary of all the entries we covered on Monday. We start off from sales on account, services on account. Second entry, estimate the uncollectible based on prior year's experiences. Third, most of the customers would pay us on time. So the middle part here is the normal cash collection entry. And then we write off some of the accounts after several attempts. If the accounts are past due, we write them off using our allowances pool, reduce accounts receivables, take them off from our journal, from the ledger. At the year end, we look at all the accounts receivables accounts and then measure up. We want to be more conservative and also use the concept of matching principles. So we take a look at all the accounts receivables again and figure out a target balance, match it with the current allowances balance we have, Difference is here, 250, which journalize another entry at year end. And at the end, if we recover the accounts, we reverse previously written off entry. Here? 200 and 250. Oh, 80 and 120, yes. Okay, so the last entry, these two entries here, we're just reversing previously written off entry. If the customer comes back to us and pay us back the money. So reverse earlier written off entry, and this last entry here is just a regular cash collection entry. Okay, so this is a summary of the entries that we did on Monday. So today we're introducing another method. So we know about allowances method now, estimating a pool of uncollectibles up front. So those methods are used for public traded companies because SEC requires these public traded companies to use this method. Okay, sorry. Now direct write-off is another method used usually for small businesses. It's less costly in a sense because the entries are less complicated. So it only recognizes uncollectible account expense whenever we identify customer A, customer B, customer C as uncollectible accounts receivable customers. That's the only time point we measure up uncollectible account expense. So if we take a look at the entry, first of all, let's say we identified again these two customers. In total, we have $200 of uncollectibles. Using direct write-off, we don't measure up an allowance account. You will not see allowances account for a direct write-off method. They only recognize uncollectible account expense whenever they determine the customers as uncollectible accounts. So earlier in allowances methods, whenever we identify the customers, we use up our allowances pool here and then assign it to accounts receivables. But for direct write-off, we don't measure up an allowances pool. So you're not using percent of sales. We're not using aging methods. We directly recognize these two uncollectible accounts as uncollectible account expense as it happens. So the problem here is that earlier using allowances method, we measure up expenses up front. So this expenses is recognized last year, last period of time. But if we use direct write-off, typically we only identify the uncollectible customers until next period of time, beginning period, or somewhere in the middle. After several attempts, we haven't been able to collect the money. So the problem with using direct write-off is that it violates matching principle. Because remember, matching principle, we always want to measure up expenses and match it against that period's revenue. But this sales revenue, $200, we already recognized it last year, 2014. But we only measure up uncollectible expenses as it happens, which typically bridges on to next period of time. Okay, so this is the entry, writing off entry. This is the first entry for using direct write-off. They don't measure up allowances, so nothing happens previous year. They only write off the customer's accounts whenever they finally determine the uncollectible accounts. Then they measure uncollectible account expense. So again, the problems here violates the matching principle because oftentimes this expense is determined next month, next quarter, or next year. For the revenues, based on these accounts receivables, earlier you made sales, provided services. The revenues you already recognize it last period of time, but the expenses here you recognize it in the second period, second month, second quarter, or even the second annual year. So this is the problem of using direct write-off because the revenues is on another statement. This expense is the later statement, in the later statements. So using allowances method, this expense is already subtracted in last year's statement. But using direct write-off, this expense is subtracted in next period statement. So meaning that next period of time, the net income is understated. Earlier period, net income is overstated because you haven't measured up this. But in reality, those sales represented in the statement, you really didn't collect it. It's $200, you didn't collect the money. So once again, the problems here, it violates matching principle, and because we don't measure up an allowances pool, you basically overstate your accounts receivables. Because some part of them, you didn't collect it last year, but you didn't measure up the pool to estimate the part, to recognize that expenses. So it violates allowances violates natural principles and overstates accounts receivables because there's no deduction account for using direct write-off. This entry? You mean later on? I'll show this later on. You mean recovery entry? Later? I'll show this in the very next slide. Okay? This is just determining the accounts that are past due. For a certain period of time, companies determine them as uncollectibles. This is the entry here. Okay? So then again, matching principles violates because expenses are not recognized in the same period of time as revenues, and also no allowance is pooled, no estimation made. So accounts receivables essentially is overstated. Net income will be understated for this period. If we use direct write-off, we measure expenses this year, which is the expense that really belongs to sales revenue last year. So net income for this year will be understated, for last year will be overstated. Okay? Okay, so let's take a look at recovering this entry. Earlier we determined the accounts as uncollectibles, and now let's say Andrews came back to pay us the money. Even though it's a couple months later, we still need to reverse this entry. So just like allowance method, we flip the previously written off entry. For direct write-off, we also just flip the previously written off entry. So we bring back accounts receivables again, reduce uncollectible account expense, flipping previously written off entry, and the second one is just a regular cash collection entry. Because we want to reverse what we did earlier and then recognize cash collection. Okay, so for allowances method, what happened in last year is we measure upfront allowance pool every single month or quarterly. And at year end, we also use aging methods to measure up again, adjust the parts based on allowances, target balance, and the current balance we have. Then when it comes to identifying customers, we use up that allowance pool, reduce accounts receivables. And if later on customers come back to us, we reverse previously written off entry, and then cash collection entry. The direct write-off is less complicated, less costly when we do the estimation, when we basically record uncollectibles, because you only measure up uncollectible account expense whenever we determine those accounts as uncollectibles. So typically that happens next period of time. It's different from the time point when we earn the sales revenues. And then when we recover it, same as allowances method, we just flip the previously written off entry, and then the last entry is cash collection. Okay, so for direct write-off, there's only 3 entries. Determining the accounts as uncollectibles, measuring expenses. Third, if we recover it, then we reverse the previous entry. And that's the second entry. And the third entry is the cash collection part, 3 entries. Okay, but once again, this method is only used for small businesses. So unless publicly traded companies really only has majority of cash sales, cash revenues generated by services or sales, and SEC allows them to use direct write-off. Otherwise, most of the public traded companies, they use, following GAAP, they use allowances method. We want to measure up, estimate the uncollectibles up front. Okay, let's apply this to a problem here. The Wisdom exercise problem tells you that Gate City Cycles had trouble collecting part of their accounts receivables, and this customer owe us $700 of money. After the account is past due several attempts, the company decides to write off this customer's accounts, so they write this off June 19th, 2012. And it tells you that at year end, this customer sends us back the check, $700. So meaning that later on we also need to recover previously written off entry. So try to journalize them now, 3 entries. One on writing it off, one on recovering, and cash collection. Okay, I'll go over this in 2 minutes. Okay, the first entry here, writing off the accounts. Using direct write-off, that means we're just recognizing uncollectible account expense whenever we determine the customer's account as uncollectible. So the first entry here, we will debit uncollectible account expense, credit accounts receivables, meaning after several attempts, the account is past due, we determine this as bad debt, as uncollectible. We write it off, basically reducing this accounts receivables amount and debit and collectible account expense. So the first entry, if we're using allowances method, we will not be recognizing uncollectible account expense, but because we already recognized this last year, we will just be using up our allowances pool if this is allowance method. We'll be debiting allowances, crediting accounts receivable. But this is direct write-off. This is the time point when we recognize expenses as we determine customers as uncollectible. The second and the third entry, after half a year, customers came back to us, pay us back the money. We reverse previously written off entry, debiting accounts receivables, crediting uncollectibles. Third entry, we collect the cash, so we increase cash, reduce that accounts receivables immediately. So the purpose of this really is just to erase previously written off entry, and then this is a normal cash collection entry. Okay, any questions on writing off or allowance methods before we move on to notes? This part here? Yes, because we... Say that again, sorry. This part? The written off entry is the first one. That's what we call written off entry, writing off accounts receivable, taking it off our balance. So the first one has a different date. Second, these two comes together because this is erasing previously written off, and this is collecting cash. Because the cash is coming in, that's why we want to reverse it. Okay? Okay, so the first part of this chapter is about accounts receivables and several issues on bad debts, uncollectibles. Let's move on to notes receivables. So this is another category of current assets. It could be current asset, it could be long-term asset. So notes receivable, typically it's more formal than accounts receivables because usually both parties sign on the notes representing this either a sales agreement or a loaning out money agreement. So later on, the creditor, whoever is loaning out the money, or the party who's making sales to customers, will not just be receiving principal amount, but also interest involved in that agreement. So this is an example of a promissory note, how it looks like. It could be a hard copy, it could be an electronic promissory note nowadays. So to understand the information here, this basically has all the detailed info on journalizing this account, this transaction. We can start off from the principal amount. So this could be purely $1,000 that Greg Toon's company is loaning out to another party, to another business or to their customers. Or it could be making sales, $1,000 on certain products, and so they agree that the customer could pay us back the money a little bit later, typically not within a month, perhaps 3 months and on, or even more than a year. But that involves interest. So the interest is stated in the last part of this promissory note. It could be any dollar amount agreed upon with both parties. Okay, so here's an example that we have 6% of interest involved in this promissory note, meaning that at the end, Holland, this is the customer or the party borrowing the money, will not just be paying $1,000 back to Greg Toons, but also 6% of interest, which is $60 involved. So altogether, the cash collection for this company, the creditor, will be $1,060. Okay, so this promissory note states the principal amount, the date the note is created. Now notice that the date is very important for understanding notes because interest is calculated based on the time period of the note. So the notes receivable could be a year, could be a couple months, could be simply stating it by the number of days. So based on different period of time, this will give us a different number of interest. because it's 6% applied to a whole year. So this is a note that was created 2014, the same day, and it's due next year, the same date. So this is a 1-year note, and based on this annual interest rate, we can directly tell you that you multiply 6% by 1,000, that's $60 in annual interest rate. But what if this is not a 1-year note? What if it's only half a year? Then the interest will not be $60, it will only be half of it. So the interest rate you see here typically is an annual interest rate unless otherwise stated. For all the problems you see in the chapter, it's all annual interest rates. Okay, in reality, most of the interest rates are stated by annual interest rate as well. Okay, so once again, this is a promissory note that is the notes receivables transactions, captures the principal dollar amount, the date the note was created, the date the note that is due. So this is what we call the maturity date of the note, meaning when is the time point when the debtor needs to pay the creditor back the money. This is the time point, a year later. Okay, and then the dollar amount, two parties agreed upon this transaction is either a sales or simply loaning out the money. So this is a promissory note. So again, the interest could be stated either by the time period of a note could be a year, more than a year, a couple of months, or simply stated by number of days. So all these could happen for different transactions that apply to notes receivables. So later on, we have to learn how to count the number of days once we want to apply the interest rate, because we need to use time period, multiply principal amounts, multiply interest rate to calculate total interest revenue our company will be receiving from customer later on, or from the debtor. Okay, so it could be yearly notes, could be monthly notes, or a daily basis note. So let's take a look at how to calculate the number of days if it's a daily basis note. So for yearly basis, it's easier because the interest rate you get, just like the slide that I just showed, the interest rate is 6% annual interest rate. And if it's a per year note, then you just multiply the principal amount to calculate the total interest. If it's stated by months, then you just multiply, for example, 3 months over 12. That will be the time period to calculate interest. So if it's 3 months notes, then the $60 of annual interest, you'll only be earning $20 if it's a 3-month note. Okay, so specifically number of days, we have to do the calculation when is the maturity date of the note. So here's an example that let's say we sign off the note February 16th. Our company signed off the note with a customer or another business. February 16th is the date that the note is created, and the note is due 180 days later. So what happens is we need to calculate this cumulative total number of days if the problem is asking you when is the due date of the note, when is the note's maturity date. So the first month you start off from, you can simply assume February has 28 days, even though every 4 years we have 29 days. But unless the problem states otherwise, you can assume February starts off 28 days. You minus 16 days to figure out how many days is left in that month. So this is the first month. Other months, you just simply add in the number of days. So March, we have 31 days, April 30 days, May 31 days. Just keep on adding to the cumulative total until you reach 180. This is the due date of this note. 180 days later, August 2014, the 15th. Okay, so this is more complicated. For a daily basis note, if they ask you the maturity date, you usually have to do this calculation, meaning that you have to know how many days there are in a month. So I assume you all know that, right? So we would start off from January, 31 days, March, 31 days, May, 31, July, August, also 31. Okay, and so what's the next month? October is 31, yes, and then December, 31. Okay, so you have to know that there's 7 months that includes 31 days, and then the others, which is February, has 28 days, a little bit different, and then, what's the second? April, June, November, these all has 30 days, okay? So make sure you go back to the calendar, make sure you know how to calculate every single month, how many days, and just add up the cumulative total until it reaches 180. Right, so this is a problem at 180 days note. If it's let's say 165, then the maturity date will be July 31st. Okay, so daily basis notes is a little bit more tedious and complicated. If it's a monthly basis note, we won't change the date. So if it's a monthly basis note, it start off from February 16th, and it's a 2-month note, then the due date will be April 16th. 3 months, May 16th. We won't change the specific date. But for daily basis, you really have to do the calculation. Okay, let's apply this to a problem here. Assuming that we have a 60-day note sign off, and the creation day of this note was March 2nd. So March 2nd, after 60 days, when will be the maturity date for this note? So how many days are there left in March? 29. And April, we have how many? 30. That adds up to 59, and then we have one more. So May 1st will be the date, right? Okay, so you start off from the first month, see how many days is left. Second month, add to the number, the previous month. And then, because this is a 60-day note, you just need one more day to get to 60 days. So this is just determining the maturity date. You have to know, because if we add an additional day or subtract another day, the interest rate will give us a different number. Okay, let's take a look at how to calculate the interest. So going back to earlier promissory note example, we have loan out money to another party $1,000. Annual interest rate is 6%. If this is a 1-year note, then the total interest accumulated that the debtor has to pay our company will be just $60. The principal amount multiply interest rate multiply time period. So usually time period, if it's a monthly or yearly basis, we use 12 as a denominator, as a base. But since this is a whole year of notes, and this is an annual interest rate, that part simply is just 1, if it's a 1-year note. Okay, because the 6% is the annual interest rate, you multiply by the principal amount, gives you a whole year of interest accumulated. Now, if this is a monthly base note, then this part here, you have to determine how many months it is that carries in the note. So if we have loaned out $2,000, another example, yearly interest rate is 10%. If you just multiply 10% by 2,000, that gives you a whole year of interest, okay, which is $200, right? So since this is a 9-month note, you multiply the time period 9 months over 12 months, because we're not calculating a whole year of interest rate. We're only calculating 9 months of interest, so this is not $200, but $150. This is an example of 9 months. If we have half a year, 6 over 12. If it's 3 months, 3 over 12, because this is an annual interest rate given to you. Now, if it's number of days, then when we calculate the interest rate, just for simplification purposes, we usually use 360 as a yearly basis. Okay, if we use 365, usually we have to round up many times. So we usually use 360 as a base, even though some of the companies also use a whole year, but both numbers are applied. So in the book, in the chapter, you can just assume a year has 360 days. So if this is a 60-day note, 60 divided by 360, multiply principal dollar amount again, yearly interest rate, gives you the total interest carried in this note. Okay, so don't forget that interest rate given to you is always an annual interest rate. So as long as this is not a yearly based note, then you have to figure out the time period. If it's a yearly based note, that'd just be 1, because it's an annual rate. Monthly basis, 6 over 12, 9 over 12, depends on how long the note is. If it's a daily basis, divided by 360. Okay, so we're covering the interest rate calculation and the maturity date first, because you will need those numbers to journalize entries on notes. Okay, so entries on notes doesn't just involve the principal amount, but at the end, when we collect the money, we also need to recognize the interest revenue that we earned. Let's take a look at an example here. Let's say that earlier, carrying on from this same example, we had notes receivables. The first line we show on notes receivables is $1,000. Assuming we are a Grex Tunes company, we loan out this money to customers, $1,000. So this was an entry that happened earlier, before this. Okay, so this is an interest entry that happened at year end. But this was the entry that happened earlier on September 30th. So we increase notes receivable $1,000, and we loan out the money $1,000 to customers. Okay. Now what happens at year end is, remember that this is a yearly note, so it's due next year, September 30th, 2015. But generally speaking, a year end on December 31st, we usually have to give out annual statements, and also for auditors to give an opinion on. So what happens at the end is that we have to estimate the interest revenue that we earned already in this period of time, even though we have not collected cash yet, because for notes, we usually collect the principal plus cash until the note is due, until the maturity date. So we want to recognize in accounting, remember that we earn the revenue as it happens, earn the revenue as sales earning process is completed, or when service process is completed. Here, when we sign off notes, we recognize revenue as time goes by. So when it comes to the year-end process, even though year-end financial statements generating process, even though we haven't collected interest yet, we still earn the interest revenue because this part accumulates as time goes by. So this is a case that at year-end, if this note carries on to next year, this year-end we need to calculate the 3 months interest that has already accumulated. It's already the revenue we earned, but it's not collected by cash yet. It's considered receivable. Okay, so this is the case that, again, based on that $1,000 in notes, from September 30th all the way through the end of the year, there's 3 months. 3 months has passed by. So we use $1,000, multiply the yearly interest rate, 3 over 12 to calculate the interest revenue earned in this year, this period of time. Okay, but since this note is not due yet, so we're not collecting interest yet, so we're just debiting interest receivable. This is a new receivable account, usually carries just minor interest revenue. And then the right-hand side, we credit interest revenue. So for notes, right now this chapter, we're assuming the company is the party collecting the money. In Chapter 10, we'll be talking about notes payable. Basically, then we're switching our roles, becoming the party that borrows money from others. Here, for notes receivables, we're the party collecting the money later on. This is revenue we earned based on signing off the notes as time goes by. We earn this revenue. But we have not collected the money yet because the note is not due. So this is interest receivable at year end. The second entry here, at year end, we have $15 interest receivable, $15 of interest. So if this is a note that only, for example, this is a note that's only 3 months, and basically we're just collecting the interest directly at year end. But since this is a note that carries on to next year and the note is not due yet, this is interest receivable as for now, because it's not yet cash. So what happens when it comes to next year, September 15th, September 30th, when the note is due? What we're trying to do at the end, when the note is due, we need to collect the cash, right? Because after we loan out money to a third party, after a whole year, they need to pay us back the money, principal amount, plus the interest part. So the total of the cash we'll be receiving is $1,000 plus $60. This $1,000 comes from notes, which previously we debited, because now we're collecting it back, we're crediting notes. And now interest receivable, the $15 was the receivable that we earned last year, but it's not yet cash. Now, after a year, we're collecting cash, so we're crediting receivables. Then this $45 is from the beginning, January 1st, all the way to September 30th. There's 9 months of interest accumulated in this period of time. It's worth $45. So the total of this really is the $60 of interest, but because it carries on to the next period of time, this part becomes a little bit complicated because we have to journalize interest, recognize last year end, and then another entry collecting the interest all together. So this part here we have okay, so the first part what we did, the entry in the previous slide, was this middle part, the first 3 months. Since we signed off a note last year, this note is not due until next period of time, carries on to two different accounting periods. So at this year's end, we journalize an interest receivable entry, this entry here, after 3 months when it comes to year end. So what happens at the end, next period of time from the beginning all the way till the note is due, there's 9 months of time. So this 9 months generated interest revenue of $45, and what we're doing here, crediting interest receivable that we journalized last year end. Together, these $60 we're collecting by cash once the note is due, once it comes to maturity date. And then crediting notes receivables, this is basically collecting the principal amount. So these together form the $1,060 here. This case that we just talked about is the more complicated case because it carries on to 2 periods of time. So if this note just simply happened in the beginning, January 1st, and then it's due December 31st, then this will not be this complicated. If it's all within a year, then we don't have year-end entry to make. It's simply collecting cash, reducing notes receivable, generating interest revenue $60 here. So if this is a 1-year note that only happens within this year from the beginning to the end, doesn't carry on to next period of time, we don't need to journalize this. We just simply have the beginning entry creating the note, and then the ending entry involving cash, notes receivable, and notes revenue, $60 directly. But this is an example more complicated that it carries on to next period of time, which in reality often happens because notes are usually could be signed off anytime. Doesn't necessarily have to be beginning of the year. So at the end, we need to journalize and adjusting entries on interest, recognize receivable parts on interest, just by the number of months that has passed by since the starting point of the notes. And then at the end, we collect receivables, generate revenue that happens in this year, together collected by cash. Okay, let's take a look at all 3 entries together. So earlier we start off from the promissory notes, the same example. We created the notes by debiting notes receivables, crediting cash $1,000, September 30th. When it comes to year end, 3 months has passed by, we journalize, recognize interest receivable and revenue earned in this year. Because usually once the note signs off, even though we haven't collected interest in accounting, we recognize the revenue as time goes by. So at year end, we recognize interest revenue, and this is considered receivables. When it comes to the maturity date, next year, September 30th, we collect the total cash, $1,000 plus $60, and this breaks down to $1,000 principal, $15 that you recognized earlier as receivables, and $45 as interest revenue earned from January 1st all the way to September 30th in this year. So this is the $45 of revenue that belongs to this year. Okay, so this is the first case, loaning out money using notes. And there's also other cases that we can also use notes, for example, making sales to customers. So the logic underlying these entries is the same. We always start off from creating the notes. But earlier we talked about loaning money, directly crediting cash. Here we're crediting sales revenue. So we can also make sales to customers by signing off notes, agreeing to collect the money a little bit later compared to accounts receivables, but also collecting interest, a part of the interest. So here's an example that we make sales $2,000 to customers and we sign off a 9-month note. The yearly interest rate is 10%. So we created the notes $2,000 on July 1st. Again, when it comes to year end, since this is a note that has 9 months of lifetime, when it comes to this year end, it's not totally due yet. So we have to recognize the interest that belongs to this period of time. So we calculate this based on principal amount, again, yearly interest rate, and then how many months has passed by, half a year. So the middle part of the concept is still the same. At year end, we recognize interest receivable and interest revenue if this note carries on to the next period. Now when it comes to the next period of time when the note is due, April 1st, after 9 months, we collect the cash, principal plus interest. This breaks down to crediting notes receivable, receivable journalized earlier, and the revenue that recognized in this year. Okay, so for notes, 3 main entries: how to create the notes in the beginning, how to recognize interest if this note carries on to next year. The second entry will be recognizing receivables and revenue. Third entry, when the debtor or the customer pays us back the money, how do you journalize cash collection on notes? So the 3 main entries for notes. So we talked about loaning out money. We talked about making sales by signing off notes. Another case here, we may also convert accounts receivable to notes. So remember earlier, on Monday, we talked about uncollectibles. And today in the beginning, we also talked about uncollectibles. So another case here, customers may negotiate with us to transfer their accounts receivables into notes receivables. So this basically is having less adversely affect toward their credit rating histories, but transferring this accounts receivables to notes gives them a little bit more time to collect and to get the funds and pay us back the money. So here's a case that if we had $5,000 of accounts receivables earlier, made from another customer based on the sales we made earlier, and now the customer do not have enough money to pay us back this cash on time, they negotiate with us to transfer this into notes receivables. So we gave them a little bit more time, a couple more months, but later on we also apply interest to it. Okay, so we reduce accounts receivables not by writing it off to uncollectibles, but by debiting notes receivables, changing it into notes. So then the middle part is again the same as the logic in notes. We have to estimate the part of interest that we earned at year end if this carries on to next year. So the middle entry is the same interest recognition entry. Okay, so principal amount multiplied the yearly interest rate 12%, and then there has been 42 days. So we just multiply 42 days over 360. When it comes to next year, beginning of next year when the note is due, we collect the cash, breaks down to principal amount, the interest receivable, and the revenue we earned in this year. Yes, 70 and 30. Okay, so the first example is the most popular one, loaning out money, creating signing off notes, calculating interest, notes creation, interest recognition, collecting cash. Second example, using notes, we can make sales to customers by signing off notes, so they'll pay us a little bit later compared to accounts receivables, but that involves interest in it. So we also need to make notes creation entry, interest entry, cash collection. This here is the case doesn't happen that frequent, but some of the companies may accept a note for those past due accounts receivables. So instead of writing it off or turning it to lawyers, they just transfer it to notes if the customer agrees to pay later together with interest. So then we transfer this to notes, generate interest, and then also has to journalize cash collection entry on principal plus interest. Now the last case for notes, another issue is, what if the notes are past due? Okay, so the past due notes, we have a term in accounting, we call it dishonored notes, meaning just the same as uncollectibles and bad debts. For accounts receivables, we usually call them bad debt if the accounts are past due. For notes receivables, we call them dishonored notes if it already comes to the maturity date and the debtor has not paid us back the money. The customer has not paid us the full amount yet. So this dishonored notes, companies also have the right to turn it into accounts receivables. Okay, so earlier the case when we talked about in the previous slide is that customer negotiates with us, transfer their accounts receivables into notes and paying us interest involved. There's also interest involved, paying us interest later. This dishonored notes, companies can directly turn it into accounts receivables, so meaning that they don't want to write it off yet if they think, based on previously sales transactions and this customer's credit rating history, they think it's highly possible that this customer will still pay us back the money. So we're not writing this off, but turning it into accounts receivables first. So again, giving customers a few more weeks or a month to get the money and pay us back principal plus interest. So the case here for dishonored notes, we credit notes receivable, credit interest revenue that has already accumulated, all together turn it into accounts receivables. Okay, companies can decide this if they think it's highly possible that this money will be collected from customers later on. If not, they can follow the same process. It's not introduced in the book, but if this is not the case, if the companies think it's less likely for us to collect the money based on their previous history, then they can just follow the same process as allowances. So there would be debiting allowances, crediting notes. So for the businesses that make sales to customers or loan out money very often, signing off notes, they may create an allowance account for notes receivables as well. Okay, so in reality, there are two different cases. This case introduced in the book is the case that if customers, very likely our company thinks that the customer will still pay us back the funds, then we will transfer this to accounts receivables, and it stays in the book for another few weeks or a month. But if it's less likely, then oftentimes company also turn this into reducing allowances account, reduce notes receivables, and turn it into attorneys. Okay, let's apply what we just covered so far to an example. Okay, we have two exercises to go through. The entry for accruing interest, and we just covered the middle entry here. What does it involve? Debits and credits. Accruing interest, interest receivables, we need to debit this account and then we credit interest revenue. Right? So if this note carries on to the second period of time, the middle entry here will be debiting interest receivable, crediting interest revenue. If this is a note that happens within the same accounting period, then we don't have to worry about receivables. We just directly collect the cash, debit cash, credit notes receivables, credit interest revenue. Okay, so we only use receivables when it comes to year end, and this note is not due yet. Okay, let's do an exercise on this problem. Tell me that this company, Wasteland Bank and Trust, lends $110,000 to a customer, signing off a 9% note that worth 90 days. So based on this problem, try to journalize, first of all, notes creation. June 6th, how do we create this notes creation transactions? And then at the end, after 90 days, how do we do the collection entry? So this entry here, since it's only a 90-day note, only 3 months, essentially 3 months, and it starts off from June 6th, it's within the same accounting period. So we only have 2 entries, creating the notes and collecting cash. There's no interest receivable entry. So the first entry here, lending money on June 6th, we will be creating this note. So debiting assets, crediting cash. So we'll be debiting notes receivables by $110,000, crediting cash $110,000. This is a transaction, creating the notes. Okay, so this is the first one, debiting notes receivables, crediting cash. Second entry, since this is a note that happens within the same accounting period, that's only within the same accounting period. So we don't have to recognize interest receivable since it doesn't carry on to next period. We won't reach a year-end adjustments. So at the end, when we collect the cash, we'll be debiting cash in total, including the principal amount plus the interest part. So the interest here, since it's a daily basis note, we will use 90 days, which is the note period of time, divided by 360. So this part here is the time period. This part here is 9% of interest rate. And again, since this is the annual interest rate, we don't just stop here. Otherwise, it just gives us the annual interest, a whole year's interest. So we need to multiply a time period, 90 days, over 360 to figure out this 3 months of interest that worth $2,475. Okay, so add these two together is the total principal plus interest, the money that our company will be collecting from the debtor later on when it's due. Okay, so remember that here we are the company lending out money, we're providing sales, so this is our receivables. It's not a debt to us. So it's a debt to customer. It's a debt to another party who's receiving the loans from us. So for our company, we are increasing assets on one hand, later on transferring those receivables into cash plus interest. It's $110,000. Mm-hmm. Yeah. 360. Okay, yes. You mean round it up? Oh, you mean when you do this computation part? Yes, you could. One-fourth, sure. But this is because it's evenly divisible, so if it's not, try not to do that. It will confuse yourself. Yes. Okay, so we start off from June 6th, right? And then there's 90 days. So in June, how many days do we have left? 24, right? And then in July, we have 31 days. So it's 55 cumulative, right? And then at the end, August, we have another 31 days. So it's 86 days. So yes, you're right. I'm sorry. Yes, this should be September 4th. Okay, so turn it into September 4th. If it's a daily basis now, then we have the cumulative total. Thank you for pointing this out. Should be September 4th instead of 6th. So it would be 6th if this problem is stated as a 3-month note, but since it's stated as a daily basis, 90 days, and we do the cumulative total, it gives us September 4th. Okay, any other questions? Okay, let's cover a few ratios and show you how to represent this on the balance sheet. So this is going back to accounts receivables in the first part of the chapter. We talked about having an accounts receivables account and a deduction account allowances. So this allowances typically is stated right underneath accounts receivables, or for some of the businesses, actually most of the businesses will report the accounts receivables as a net dollar amount. So meaning just merging these two accounts and directly representing $2,400 in the statement. So either way is used in the business, but oftentimes this just gives a already merged the two numbers, so just give you the net dollar amount for accounts receivables. So basically these are the net realizable value for accounts receivables. But for learning purposes earlier, we told you that you can list accounts receivables and then underneath it right away just list the allowances account. Either way represents the same information here. Okay, so for depreciations, oftentimes companies also represent the planned assets, and then deduction account accumulated depreciation has a net asset value, just similar to accounts receivables, the net amount here. Oftentimes businesses also represent book value of planned assets here. Okay, now we have a couple of ratios to cover to help us understand how to analyze what we covered so far. How to analyze the business's receivables, whether it has been turning into cash quickly or not, comparing to its same business, different years, or different businesses across the industry. First ratio here is what we call asset test ratio. The underlying concept is very similar to a ratio that we already covered earlier called current ratio. So remember in Chapter 4, the definition of current ratio is that we want to know how much current assets we have to pay back current liabilities. We're just looking at current assets divided by current liabilities, and at that time we told you that the rule of thumb is about 1.5. So this was Chapter 4. Asset test ratio is more conservative than current ratio. We're specifically only looking at three categories of current assets. We're looking at cash, we're looking at current receivables, which in this chapter we talked about accounts receivables, notes receivables that are current. So only the notes receivables that are due within a year is considered, that falls into this category. And then the third part is short-term investment, which we haven't discussed much on. Basically, this number will be given to you directly. So this is bonds and stock that the company made investment in, which can turn into cash very quickly. Not long-term ones, only short-term ones. So this number will be directly given to you. We will cover this in more detail in Chapter 10 and 13. So this asset test ratio, we're only looking at three categories of current assets and see if the company has enough of these quick assets to pay back its current liabilities. So this is more strict than current ratio. At the end, the number that gives us, generally speaking, if it's about 1 and above, this ratio is considered pretty strong. So for current ratio, it's 1.5. So for asset test ratio, we take off inventory, we take off prepaid expenses. We're only looking at cash, net receivables, and investments. Add them together, divided by current liabilities, to figure out how much current assets a company has to pay its liability if it becomes due immediately. Okay, so these ratios are helping users of financial statements to have a better understanding using different aspects. Inventory part in Chapter 5, we talked about inventory turnover rate. So in Chapter 4, we talked about current ratio, debt ratio. These are using different accounts, different numbers to help us get a better picture of how the health condition is for this company. So this is understanding whether companies has enough current assets to pay back current liabilities if they suddenly become due, if they are due immediately. Okay, only specifically looking at these three categories. So when you look at a problem, you just need to pick these three amounts: cash, short-term investments, net current assets, and then divided by accounts payables or short-term notes payables, current liabilities. Okay, so the idea is the same as current ratio, understanding current assets dollar amounts compared to current liabilities if we have enough current assets to pay current debts. So this is asset test ratio. Another ratio is days of sales and receivables, specifically looking at how quick the collection period of receivables. So we want to know, remember that in operating cycle, we start off from purchases. We make sales. And then that sales at the end, if it's credit sales, it has to turn into cash for us to have enough cash to make another purchase, to make sales again, to continue the operating cycle. So this ratio, days of sales and receivables, we're understanding the collection period of accounts receivables. How on average, what is the time period for us to turn receivables into cash? This is what this ratio is. It's basically giving us the number of days on average we collect our receivables. Okay? So we start off from calculating daily sales, 1 day's sales on average. So you'll be given the net credit sales in total, and you just divide it by 365. This will give you the first part, daily sales. Then the second part, we want to know, within these accounts receivables, how many days of sales are still within these accounts receivables. So we use daily sales to divide average accounts receivables. So when we talk about average, this represents beginning receivables plus ending divided by 2. So on average, we have a certain level of accounts receivables, and we want to know how many days of sales this represents. Okay, so let's take a look at the detailed formula. Assume that we have $22,600 of sales in total, credit sales, not the cash sales. So credit sales in total, we divided by 365 days to figure out per day's average sales value is about $62. Okay, so this is the first step for this ratio. We calculate daily sales first because we want to compare it against the net average accounts receivables we have and see how many days that turns into cash. So this is the daily sales, the first step. And notice that we use 365 days, so don't confuse this with the interest. So for interest, we calculate a yearly basis, we use 360. So for the ratios, this is usually only a one-time thing we do at the end. So we just use 365. Second step, these $62, we use it to divide average receivables. So average receivables, you'll be given the beginning accounts receivables, the ending, add them together, divided by 2, and then you divide it by daily sales. So this may seem a little complicated to interpret, but basically what we're trying to do is compare average accounts receivables and understand how many times it exceeds daily sales. Because if you think about it, if these two numbers are the same, what does it mean? Let's say our daily sales is $62, and every day on average we have accounts receivable $62. So that means at the end of the day, at the end of each and every day, we make credit sales, but then we collect them immediately. So that will give us the same amount of accounts receivables and sales. That's what it represents. If this part is 0, that means we make cash sales. We don't have credit sales. So if these two numbers are the same, we have $62 of daily sales, we have $62 of average accounts receivables. That means we collect our receivables every single day, which is least likely to happen because the whole point of credit sales is to give customers more time to pay the money. But to illustrate the point, let's say we have 2 times more than the daily sales, 124. And that means every other day we collect the money. So this will give us 2, which means our collection period is 2 days. So this ratio here, after you determine per day sales, we want to know within the average accounts receivables, how many days of sales are still within the receivables. So this will give us the collection period of sales, 40 days. So after you get this number, this is useful if we compare it with the credit terms we offer to customers. So meaning that if we usually make sales to customers, the net credit term is 30 days, assuming it's 30 days. Then if this on average collection period is 40, that means most of our accounts receivables are collected not on time, past due. So we usually compare this on average collection period with the credit terms we offer to customers. If the credit term is 45 days and this is 40, that means we're collecting the receivables pretty much on time and a couple of days in advance. Okay, so usually at the end, this collection period, we compare it with the credit terms and see which one is smaller. Preferably, we hope that this collection period will be within the credit terms we offer to customers. That means that we're collecting receivables on time. Okay, so the first step again for this ratio is to calculate per days of sales, and then we use this to compare it against the average level of accounts receivable. Okay, now we just have one more ratio left. Basically, it's mirroring this days of sales and receivables. So this one is looking at the average collection period of receivables. This turnover ratio is just flipping the numbers and taking a look at how many times credit sales exceeds net average accounts receivables. So meaning that if we have a smaller collection period, if our collection of receivables are always on time, then our turnover rate will be higher. Because the higher the turnover rate is, that means the quicker the receivables are turning into cash. So let's take a look at these numbers, assuming that we have credit sales $22,600, and if our average net accounts receivables is also $22,600, that means that basically all the credit sales we made, we haven't collected any cash yet. So if these two numbers are the same, that means we haven't collected any of the receivables by cash. So preferably for companies, they would want this denominator part to be the smaller the better, the lower the better. Because the lower this is, that means the higher cash is. That means the quicker receivables are turning into cash. So average accounts receivable turnover rate is comparing the rate of credit sales with average accounts receivable. So the higher this is, that means the quicker receivables are turning into cash, and then the company is generating the cash level quicker, collecting the cash quicker. We don't have a rule of thumb for this. You have to compare it, just like inventory turnover rate, we usually compare it with different years, because different industries, it's hard to judge this. Because grocery stores, they may turn over it very quickly, but some of the stores that sell equipment, furniture, we have different rates for this.